Welcome to our Ukrainian Dynamics 365 and Power Platform user group. This is our next meetup. We try to handle it every 2 weeks. Here we discuss different technical topics related to the Dynamics 365 applications, both CRM and DRP, also Power Platform and related technology stacks. We host meetings in Ukrainian and in English. So keep posted. Yeah, thank you very much, guys, for helping with the organizations. Max Ponomarov, Max Martinov, and Valentin Gasenko. Thank you very much for helping organizing it, finding speakers, and the other work to continue working on with our meetup and user group. So also please note that we are recording this event. The video you can find later on our YouTube channel. Today's speaker is Oleksandr. Oleksandr is Dynamics 365 supply chain management professional who will tell us about the basics of inventory accounting. So, Oleksandr, please start the presentation.
Okay, thanks a lot for inviting me to this session and giving me an opportunity to speak. I'll speak in English, but I don't mind switching to Ukrainian to explain something if there will be questions, of course. It's just due to the nature of our work, it's almost easier now even to present in English about the solution, because otherwise I would be just using a lot of transliterated English terms anyway. So the topic for today is about inventory accounting, and I wanted to start with basics, which includes the parameters that influence inventory postings to ledger, and basically this is the focus of and what's usually understood under inventory accounting is how inventory transactions are reflected in ledger, in general ledger, and basics of this kind of integration between inventory and ledger. So I'm going to describe which parameters influence the transition of values from inventory model to ledger model, and also different models that we can use in order to account for inventory dynamics. Very little bit about myself. I'm currently work as a freelancer, solution architect or implementation consultant on several projects. And in general, I have about 10 years of experience by now, and I came into ERP side from the business side, as I was working in imports logistics before that, basically. So I have a little bit of hands-on business knowledge about this side, and I really enjoy helping customers to better reflect their business processes in Dynamics. So as the inventory model goes, there are different kinds of operations that are supported by inventory management in general, and they usually involve inbound operations, receiving products. There is also quality assurance as a separate substream. Internal warehouse operations, meaning movement of goods inside of the warehouse. Also outbound operations where we pick and ship the goods, and inventory control operations, those which allow us to maintain correct stock. And what I'm going to focus on today are the operations which integrate closely with ledger. And those are inbound, outbound, and inventory control operations. And now also, just to give wider overview of the landscape. So for inbound operations, we usually understand where we create a supply request and the vendor delivers it to us. We do some kind of arrival overview at the dock. We may post item arrival journal. We load the internal transport. Then we have packing slip or product receipt update. And once we do product receipt update, the goods move to receipt. So out of these operations, the postings to ledger happen at the last two stages. Basically, it's packing slip when we post packing slip and when we post invoice, we do postings to ledger. Whatever we do before that is usually not, aside from any customizations, of course, but is usually not posted to ledger until even the registered state. When we already have the inventory and we can use it, place it in the warehouse, but until we post the document, we don't have it financially. Same on outbound operations. We also have different stages of the order, different stages of basically of order line status or transaction status, where it's moving through from the order. We're getting it reserved, then we do pick list, and then we send a shipment, and we update update packing slip and invoice. And once again, whatever we do inside of the warehouse is not reflected in ledger. We can reserve it. The stock, the cost of the stock is not impacted when we reserve. When we pick it, the cost of the stock is not impacted as well, which sometimes can be confusing for end users who are used to different systems, like I don't know, SAP or something else. Because I had some hard times to try while trying to explain why do we have 0 or 1 piece on stock, but we costed it as 5 pieces. They don't see it in physical inventory when it was picked, obviously, which means that they don't understand what happened to it and why does one remaining piece cost so much. But it is because we didn't post packing slip and invoice, which will generate 2 sets of ledger postings. So there are, as based on what I explained also, there are no one-to-one relations between ledger transactions and inventory transactions. There are several tables handling this connection between them. And if you have some technical knowledge, or you can, if you're interested in details, you can look in the application tree into relations connecting the tables like invent transposting and invent settlement. But in general, multiple transactions can be summarized into one ledger transaction. When we post a document, we have usually one ledger transaction, which will cover multiple inventory transactions. And also, if we, for example, we could be doing operation, for example, which is, for example, charging. We can add the charges to the order and allocate them down to transactions. And this will be basically one transaction distributed into multiple inventory transactions. Okay, here I wanted to touch on the physical posting of inventory transactions to ledger. As from what I explained before, we can have when we post any inventory transaction, we have two statuses identified as physical posting. One is when item is received but not purchased, which means that product receipt was posted but not purchase invoice. And another is when packing slip on outbound shipment, packing slip was posted but not sales invoice yet. And also there are similar there is similar case with production, where we have picking list and we have reporting is finished operation, which can also be posted to ledger. And all of this is controlled with these four parameters I have on screen. So there are, I mean, we need to understand when we implement the solution, if the customer wants to post these transactions and reflect them in the ledger or not. And they are posted, they can be posted to separate accounts. And once they are posted, once the proper invoice is posted, the physical posting is reversed. And this usually allows the customer to maintain reports such as received not invoiced or delivered not invoiced. They can have different names in the business. For example, goods received not invoiced, GRNI, and so on. So sometimes it's really important for the customer because they have reporting requirements, they have regulatory requirements, or simply the management requires to maintain a separate ledger of these things. So the rules of inventory accounting are driven by two entities in the system, which are represented as item groups and item model groups. And they can be found in inventory management setup inventory. So item groups are used to define different accounts, ledger accounts, for different types of operations. As I was explaining, we can have different kinds of postings. For example, on sales order, we can have the packing slip posting, which can have its own ledger account. All the item groups that have similar rules of posting can be all the items that have similar rules of posting and similar accounts have to be set up as a separate item group. Yeah, the setups are split basically into different order types, and it's very common to set it up. Usually, you would need at least something like finished goods and services, or maybe raw materials, finished goods, and so on. And item model groups contain settings which are related to how we want this group of items to be accounted, at which time we want them to be accounted. So item model groups define when we want ledger postings, and item groups define where do we want where do we want ledger postings, to which accounts, I mean, for different items. And they can overlap, of course. So if we take a look from here, we can have, for example, audio products and audio RM products handled as FIFO, and they will have the same item model group but different item groups. And that will mean that they will be posted at the same time, at the same set of transactions, but to different accounts. Okay, yeah, so we have one important field which defines a lot for the product on the item model group is the stocked product. And the stocked product parameter is important because it governs if we post inventory transactions at all for the item. We can have obviously services which can have the stocked product cleared. Then we don't post any inventory transactions. We don't account for them in inventory, and we cannot use it in journals. So we cannot just use movement journals or adjustment journals to post this product. However, we could have stock transactions on services that are part of that contribute to inventory value of physical goods, and such services will still generate stock transactions if a service is used as, for example, part of the BOM or formula, because it's subcontracting some processing of the item. So we are buying a non-stocked item, but the system will still generate stock transactions because it will use the value of this service in calculation of the item cost. And yeah, so there is, for information, a list of different entities that generate transactions only for stocked products. While on sales and purchase orders, we can buy and sell services. We cannot use non-stocked products on production orders, transfer orders, and yeah, inventory journals, most important. Then we have a group of fields. It is called ledger integration and recognition of cost. So these are also important fields on how do we want to, when do we want, and not how, but when do we want to post transactions to ledger. What I was saying earlier about physical inventory postings, it's governed on the item model group. And financial postings are, as well. So we check post physical when we want to post item. It's if simply said at packing slip and product receipt. We check post financial inventory if we post it on sales invoice and purchase invoice. And there are this recognition of cost is basically used. I may be mistaken right now, but if I'm not mistaken, it's used when we purchase goods which are not marked to post physical to post physical receipt to ledger. We still accrue liability, for example, on product receipt. Basically, it defines different types of accounts to post at the same time when we do physical posting. So here's more explanation of the same, that when we do posting physical inventory, we are checking those parameters that I mentioned before on accounts receivable, accounts payable, and production control page. So if we select post physical inventory on item model group, the system validates these parameters. If we don't select it, whatever we have in parameters is also not applied. So that allows to have different combination. For example, we can have a combination where we don't post to ledger in production in general, post to packing slip and product receipt to production, to post packing slip and product receipt in general, but on separate item model groups only, not on all. So the cost of the goods is posted to ledger when we have post physical inventory checked. This means that, and this is actually a very important thing to note between cost of the goods at the time of receipt, I mean physical cost, and financial cost. For example, there are cases that I have investigated where we are posting a certain amount to physical to the ledger on physical receipt, and that is pure cost of the item. It does not reflect the actual cost of these items of this particular purchase order. Usually, it's either a plain purchase price, or it's, for example, or it is just an average. In case of weighted average, it's average cost of goods currently in the inventory, which can really vary with the actual financial cost of the same transactions that will be posted only when we close this with the purchase invoice. What I mean is that on purchase invoice, we can usually have surcharge, we can have delivery charge added, we can have any kind of different factors that influence final financial cost of the receipt. And at the time when we post product receipt, the system doesn't know this information yet, because the user can change it at any time after that. So the system is posting some generic cost, an average cost or just regular cost of the item, depending on the item model group. And then once we post the invoice under the same purchase, the transactions that we posted on product receipt are reversed, and the proper financial cost is posted to the proper account set up for purchase invoice already, which can have different effects on the inventory in the live production system, because different things happen, and people sometimes post transactions backwards. For example, post them in a previous period, which results in very common situations where when we were posting this product receipt, we had one cost on average for this item. Then someone posted some backwards transaction. Then we post a normal purchase invoice, and we reverse a different. We reverse this cost, but with a different value, because the average value of the stock has changed, and or FIFO was changed, for example, and then the system recalculates it, and so on. Usually, these strange situations are reconciled automatically during inventory closing, but there are some item model groups for which closing is not done, and then the users are forced, or the accountants are forced to investigate it and do some corrections manually in that case. Right, so post-financial is probably easier to understand, because it's posted when we close with an invoice. We post it all the time when we post invoice for our item, which is in this item model group. And basically, at the same time, if we had physical postings from before, as I was saying, they are reversed. The value of goods is reversed. And then we have postings on the inventory issue and consumption account. So, for example, when we post sales invoice, we write off cost of goods to consumption account, and we post invoice value to the invoice account. Then there are several fields, such as physical negative inventory and financial negative inventory. They're interesting that they, like in different implementations, I had different setups, but most recently most recently, most of the companies, they try to not turn on physical negative inventory, but they can turn on financial negative inventory. So what this means is that if we enable financial negative inventory, we can sell more than we purchased financially. But if we at the same time don't clear the checkbox on physical negative inventory, we do not allow physical negative. Then we have, so like it may sound like it's complicated, but in fact it's like this. So we receive a pallet at the warehouse and we register it. At that time, no postings happened, but when we register, we post it physically, post physical inventory, not cost, but just we register physical inventory. And if we have financial negative enabled, we can sell these goods and we can even invoice them. But if we clear financial negative, once we register it, we can still ship it or pick, for example, but we cannot post sales invoice until we post purchase invoice. So the system will not allow us to do that. And usually, if we check physical negative, that creates a lot of mess, because if we allow physical negative, that means that even if we have 0 in on hand, someone can still generate picking list, close it, post packing slip and sales invoice, and do all of this while we don't have anything, and do all of this for hundreds and hundreds of thousands of items. So there were some cases where it was allowed. It is usually in a company with where it's a complicated process to receive the goods. For example, which includes a lot of quality checks, a lot of other validations. I don't know, requires a matched documents. Maybe they want to investigate why they didn't receive something. But they physically have the goods and the client is at the door, so they can just take the box, give it to the client, post sales invoice, and handle all the continue handling the complicated process on receipt further. But yeah, I mean, recently I haven't seen the projects where physical negative was allowed, but financial negative is quite common. I mean, it's the same thing. So if we receive the goods, we can register them with mobile device or with a journal, item arrival journal, however else, and we can sell them with no implications for us, even if we didn't post purchase invoice. I mean, I don't really know if Ukrainian accounting actually allows to do that. Because I mean, I worked on a Ukrainian project, but it was 8 years ago. I mean, I think we had a rule against doing that, but it was handled with back date posting. So we posted it. We posted purchase invoice at the day of actual receipt, but it was happening in a week or in 2 weeks. So that's why we had it allowed, like financial negative. Yeah, there is some more information related to the physical update field group, which is also configured on the item model group. So it includes validations to what I was saying before. For example, we can select registration requirements, receiving requirements, picking requirements, which means that these are used to build that complicated process where we have to register it before we can post product receipt. We have to receive it before we can post invoice. So it adds these additional, which may seem like it's unnecessary steps, but in fact they are all really, they all have meaning, and they introduced usually for a reason. And in some cases, for example, receiving requirements, some companies do not like, because once they register the goods, they just post the invoice directly. They don't want to handle product receipt posting separately, for example. So they post both documents like at once and during invoicing. Same about picking requirements, that we have to pick the item before the inventory is actually, well, before we can post a packing slip. Right, so in the reservation field group, it's also additional controls for reservation, which means that if we want to maintain a FIFO date control, which is usually for batch tracked items, that we have to maintain first in, first out principle, and reserve the batches that we received first, and not so that they're not staying for too long in the warehouse. Right, so then we also have automatic or explosion for reservations, but that's not really like it's still settings on the item model group, but they don't really influence accounting. However, what does influence is different inventory models, and so this is the core why we create in item model group. We can have the same settings that I discussed above in many different model groups at the same time in the system, but this is actually the core of why we have different item model groups. So inventory model is how do we do the costing of stock, and it has far-reaching implications for the project. So yeah, there are several item model groups. Most prominent of them are FIFO, which is first in, first out. Lifo, last in, first out, is the opposite. When we first ship what we last received. Haven't used that in a real project, to be honest. Then we have weighted average, standard cost, and moving average. So weighted average and standard cost I have used in a lot of projects, as well as FIFO. So FIFO is for first in, first out, is an inventory model where we ship what we have received first, and we have to ship it first. But what I mean, the implications that we have for costing is actually that any issues from the inventory are settled, which means they're matched against first financially updated receipts into inventory based on the financial date of inventory transaction. And that's another thing which is important to keep in mind, that an inventory transaction has different dates. It has inventory date, it has physical date, and financial date, where inventory date is when we actually did a registration or picking, physical date when we posted packing slip or product receipt, and financial date when we posted the invoice. And this model, so this model is used usually at the same inventory which is handled during reservation as first in, first out. And we also have a marking process. So, yeah. We have a marking process also, which is linking these two transactions. Usually the system is linking them automatically at the time of posting. However, we have two options basically additionally. One option is to mark directly. For example, we received the goods and we know that these were goods like a special order for someone that has a special discount for that customer, and we sell it right away. So even if even if we received it last, we would still want to mark it against to calculate all the margins that someone in management wants to calculate all of that correctly, because and we can use inventory transactions form to do the marking, or directly from the order we can do the marking in case of FIFO. If we didn't mark it manually, when in a FIFO in an environment that has FIFO items, it's usual to run periodic inventory closing job. And when we do that, the system leaves anything that we marked manually, it stays. However, what was automatically marked against the first financial purchase, the system is re-evaluating all of these things and correcting marking when it can. So that means, and again, I'm talking about backdating transactions. So, for example, we post an invoice on the on the 1st of March, and we are selling goods which we received in February, but no one posted that invoice yet, because maybe accounting is verifying some charges or doing some other checks or something like that. And the system is marking that transaction automatically with the first transaction from February, for example. And that first transaction from February was on 28th of February. Then someone in the accounting is finalizing anything that they were doing with an item or with an invoice, and they actually post that invoice, but they post it on the 20th of February. So when we are closing February, the system will analyze all these transactions, and when it will see that it can switch, that it has free values left from invoice on the 20th, it will remark that sale from the later invoice to the earlier invoice automatically. Sometimes these kind of things that happen at the time of closing the period, they cause issues where the marking breaks. When, for example, we are selling goods, also backdating because someone wants in sales, they want a nice bonus, of course, and the bonus is calculated per quarters. So just when the next quarter starts, they usually start backdating sales. They just want it to be accounted to the previous quarter bonus. But if they're at the same time they're selling goods which arrived in the actual quarter, for example, in April, and they're selling it on the March, that creates a break in marking, and the system will give you warning, an error during closing that this transaction is not marked properly. Okay. So then, so we have, when we are working with FIFO, we also have running average cost price, which represents an average of the financially updated transactions. And if we can have also include physical value option. on the item model group, and when it's selected, then both transactions, I use physical and financial receipt transactions to calculate running average cost price. And running average cost price is the cost that the system is using in transactions, in issue transactions that we are selling, physically issued. That's what I was saying about earlier, that when we post packing slip or product receipt, we're using average cost and not the real cost. Then we also have Lifo, but I mean, I only have general knowledge that such a model exists, never used it in the real environment. So issues are settled against the last receipts into inventory. This model also supports inventory closing as a periodic operation. And you can also use marking. Now, weighted average is another, like a different approach to costing, where we have where all the issues from the inventory, they have a cost value of the average value of items that are received in the inventory. I mean, and it's like we also do inventory closing here, but it is done in order to calculate total received quantity and value, and all receipts are settled against that value. So basically, all receipts get an equal share of total cost of all receipts, which can means that we can have different kinds of purchases. We can have something flying in with a helicopter, or I don't know, maybe airplane or container from China, or something that is simply produced in the warehouse. And if it's all happening with the same item, generally the receipts should have different costs. However, with this model, when we do the closing, we calculate total of these receipt costs, and we divide it equally across all transactions. And then any issue transactions, they are also marked against the receipt transactions in the same way that is done with FIFO, but they are as a result, they are marked with against average value. So whatever we received, whether it was received by air or by sea or by road, it all be sold with the same averaged cost price of everything that we received in this item. And moving average is basically it's an average principle where the cost of inventory is not changed when the purchase cost is changed. The difference is in capitalized, and the amount that remains is expensed. So the most important piece to keep in mind is that during moving average, while we post transactions for moving average products, we cannot use marking and inventory settlements, and there is no inventory closing basically, as it doesn't generate any settlements. As a result of this, what I had in a project in a live situation, it was a problem that we couldn't mark, we couldn't reserve actually specific transactions as well. So when we mark, we can also reserve transactions that we have marked, which is useful for direct deliveries where we buy something from the vendor to be delivered directly to the customer. In that case, moving average is not a good fit if such transactions, if there are a lot of such transactions, because you will just not be able to, you will be able to create direct deliveries, sorry, but if you want, if you will have a separate purchase order and a separate sales order, you will not be able to connect them directly to each other. So it was an unexpected and unpleasant surprise in one of the implementations that I have. Yeah, so there is also, I think, one thing, one of the models left is the standard cost. Unfortunately, I seem to have no slide for that. But in general, standard cost is set up on item and site. So different sites can have different standard cost. It's usually used for production, for environments where we have production or manufacturing, and the standard cost can be automatically calculated or can be simply manually entered because someone calculated it outside. And then anything we post is basically posted with the same cost, regardless whether it's purchase or issue. So inventory will be always like quantity multiplied by this cost. What's good about it is that we can have different costs depending on the site, because and it's important because in production environment, different sites can have different, for example, production lines. And some production lines can use more expensive equipment, some production lines could use less expensive equipment, and all of that can be reflected in the standard cost for different sites. And it can be also automatically calculated based on a formula or BOM for production, which is also quite useful. So I guess I generally covered the plan that I had in mind for the basics. I can also, I'm basically open for questions now, or if you have any specific question or any specific topic within this kind of scope, I can discuss more on that.
Yeah, I have a few questions. First of all, thank you, Oleksandr, for sharing this with us. I know how complex inventory accounting and management in the system is, and this is it's impossible to explain it briefly in 60 minutes, but somehow you did it. So thank you for sharing this with us. A few questions that I have. First of all, what is the most common mistake you have encountered on projects that you participated?
Mm-hmm. Thanks for the question. So as I was saying, the most unpleasant one was when moving average was moving average and standard cost both don't allow markings. And when we had a project with moving average, already way into the project, it was uncovered that sometimes in some like 20% of cases, they do want to reserve goods from a specific purchase order into a sales order.
Right.
And they wanted to do marking, in that case. And I was just, yeah, okay, here's the marking form. And then, no, it's empty. Why is it empty? And then, okay, yeah, now I will remember it. And another common thing, but it's not an implementation mistake, it's user mistake. What I mentioned is where users start backdating things, and we have a FIFO or a weighted average with a periodical inventory closing, And when they start backdating, when they backdated during a period, it's not an issue. The closing will rearrange everything, remark everything, and everything will be good after that. However, when it's happening in between periods where new period started and you're selling something in the previous period what you received in the new period, that just breaks during the closing. Also, one other thing is for weighted average. Yeah, exactly. So for weighted average, it was due to the fact that the customer really spent a very, very long time to analyze and post their purchase invoices, which could track for several months, which means that if you remember about, just quickly about weighted average. So the weighted average is value of financial transactions that we received, we divided by the quantity. However, they didn't post the transactions for a long time, but they have sold them also many, many months ago. And the cost was just incorrect because the cost of receipt was not accounted in this weighted average calculation. And they should have used, in that case, this physical value. If it's marked, then the physical transactions are also included, but they didn't use, and there was a really long investigation required for that to even find that. That's why they have cost like very low cost for an item, because they had a lot of this item and a lot of purchase invoices not posted at that time.
Interesting. So it seems like those mistakes commonly related to the fact that users are cheating the system and they neglect the procedures, the common procedures that you have to follow. They neglect the month close and nobody looking after unclosed documents and etc. etc.
Yes,
they just
exactly.
Disregard it. Thank you for sharing this. Another question I have you encountered a human error on one of your projects that could not be fixed without a developer? And what kind of error that was? Like something where users actually cheated the system, like for example, as one of those mistakes that you mentioned, but you couldn't fix it, out of the box with features out of the box, like reopen the period, rerun the inventory closing, and so on and so forth, and you have to rely on developer.
Basically, in that project, it was really hard to do because, as I was saying, several months were really passed, and it was virtually impossible to reopen all of that because, first of all, it takes time to post the reopening, and then something else could, on reclosing, something else could go wrong, and they were really worried about their balances. So what they actually did, and which added in the end to confusion and which added to the errors, whenever they saw a strange difference, like, okay, we have 50 pieces, but the cost is only for 40 pieces. Why is that? No one knows. Okay, let's post a ledger journal that will throw in some money into that account. And the money was thrown into account with ledger journals, but it was not actually distributed to goods. So when they sell it, they still sell it with the wrong cost price. And then at the end of next period, they again check, oh, we have some more discrepancies. Why is that? Oh, okay, let's correct this quickly with another ledger journal. So, and the errors accumulated. And in the end, it was really hard to take it all into account, to take all of the postings and match it all. Yeah, and it's things like that. And in general, yeah, in general, you can. A lot of times you can really, if you catch the error quickly, if you use standard logs, so during inventory closing, you can have a standard report that will show you all the errors before you can actually close. It will show you the markings that will break during closing. And if you correct it before closing, then you're good. So, yeah.
All right. Well, I know we ran out of time, but one last question I still want to ask you. What would be your piece of advice to newbies, newcomers, to someone who is just learning, starting with inventory management module? They have no idea what to do with it. This is a huge beast. This is one of the most complex parts of the system, and it's really heavy. And so what would be your piece of advice to someone who is starting into it?
Well, they should really start with Learn at Microsoft, because there are a few like good descriptive courses on this topic. Also, how to configure item groups and item model groups. And I also wanted to add that anyone who is working with this model should really learn inventory value report. It's a separate. I really wanted to talk about that as well, but it would have taken too long. And inventory value report is an entity that you can create, and when you create, you select several parameters there, and then it takes all of these things what I discussed, including something like this ledger integration and recognition of cost and production is also there. So it's taking all of this and it's building reports. And in the report, it's trying to reconcile and match what we have in inventory transactions and in on hand against what we have in ledger. And it would really help that person to really understand how things work if they can dig into technical side of things and dig into view with relations and tables between relations into that reporting, how the report is built technically. Because it has a lot of views grouped together, which basically you understand better how this system works and what the system considers as financial cost and how it defines what was financially posted in the period. So a lot of this is in those views, and a lot of things which do not come to mind right away are visible from there. Like it turns, like, for example, financial cost is not just cost of the item. Whatever you post as adjustments later is actually a separate table which has separate fields, and that is also is included into this financial cost, and that can be clearly seen from contents of the report or from the technical side. Because if you just run it functionally, if you just run it and you get some values, you will not really
grasp it.
Grasp why is it this value, and why on the same account which is supposed to have the same value it's different. But once you start looking into the backend, what's called, and dig into how the report is built, and from that one small field with amount is built and accumulated from different tables and different values from different fields together, then you can sort of start to understand how and when is everything posted. It helped me a bit. So.
Thank you for sharing this, Oleksandr.
Okay.
All right, I think we don't have any other questions, at least in the chat. So I think we can wrap up at this point, Elizabeth.
Yep. Yeah, I don't see any further questions. So, Oleksandr, thank you very much for taking the time and sharing your knowledge about the inventory accounting and spending your evening with us. today.
Okay.
We hope you will join us again in other meetups. We invite you join again and continue this topic or maybe cover some others.
Okay.
Yeah,
That'll be
so
good.
thank you very much. Yeah, the recording of the presentation will soon be posted on our YouTube channel. We will announce it later. Also, in the chat of this event, we are posting a link to the meetup feedback form. So please leave a review of today's session. We are waiting for you in 2 weeks, and yeah, keep posted on the next topic. Thank you very much for coming today.
Okay, thanks a lot for inviting.
Yeah, have a good evening. Bye.